Have you ever heard people talking about deltas, gammas, and thetas and felt like you were back in a college math class? Well, what if I told you these Greek letters are actually the secret language of Wall Street, and understanding them could unlock a whole new level of financial savvy? Stick around, because today we're demystifying the financial Greeks and diving into the world of options trading. But don't worry, we're doing it in a fun and super easy to understand way. So, what are these Greeks, anyway? In finance, especially in options trading, the Greeks are a set of risk measures that tell you how an option's price might change. Think of them as the vital signs of your investment. The most common ones are delta, gamma, theta, vega, and rho. It sounds complicated, but each one tells a simple story. Let's start with delta. Imagine you own a call option on a stock. Delta tells you how much your option's price is expected to move for every $1 change in the stock's price. A delta of 0.50 means that for every dollar the stock goes up, your option's price will go up by about 50 cents. It's like a speedometer for your option's value relative to the stock. Pretty cool, right? Next up is gamma. Gamma is the accelerator. It measures the rate of change of delta. If delta is the speed, gamma is how quickly that speed changes. A high gamma means your option's delta is very sensitive and can change rapidly as the stock price moves. This is especially important for traders who want to manage their exposure as the market fluctuates. Then we have theta, and this one is a bit of a villain. Theta is also known as time decay. It represents how much value your option loses each day just because time is passing. Options have an expiration date, and as that date gets closer, their time value melts away. Theta tells you exactly how much you're losing to the clock. It's a constant reminder that in options, time really is money. And let's not forget Vega. Vega measures an option's sensitivity to volatility. Volatility is just a fancy word for how much a stock's price swings up and down. If you expect a big news announcement to cause a lot of price movement, you'd want to pay attention to Vega. A higher Vega means your option's price will be more affected by changes in the market's expectation of future swings. Finally, there's rho, which measures sensitivity to changes in interest rates. Honestly, for most retail traders, rho is the least important of the bunch, as interest rates don't usually change dramatically day to day. But it's still good to know it's part of the family. Now, how does this all tie into options trading? An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a set price before a certain date. There are two main types: call options and put options. You buy a call if you think the stock price will go up, and you buy a put if you think it will go down. Let's make this practical. Imagine you believe company XYZ, currently trading at $100, is going to soar. Instead of buying the stock directly, you could buy a call option. Let's say you buy a call with a strike price of $105 that expires in 1 month. If the stock jumps to $120 before expiration, your option becomes very valuable because you have the right to buy the stock at $105, way below its current market price. But what if you're wrong? If the stock stays below $105, your option expires worthless, and you only lose the premium you paid for it. This is one of the key appeals of options. Your potential loss is capped at the price you paid for the option, but your potential profit can be substantial. Understanding the Greeks helps you choose the right option. Want an option that closely tracks the stock price? Look for a high delta. Worried about time decay eating away your profits? Be mindful of theta. Expecting a big price swing? Vega is your friend. The world of finance can seem intimidating with all its jargon, but at its core, it's all about understanding relationships and risk. By learning about the Greeks, you're not just memorizing terms, you're gaining a framework to make smarter, more informed decisions. It transforms trading from a guessing game into a strategic one. We've only scratched the surface today, but I hope this gives you a solid foundation and makes the financial world feel a little less mysterious. Remember, every expert was once a beginner. The key is to stay curious and keep learning. If you enjoyed this breakdown and want to learn more about finance and investing in a simple, fun way, make sure to hit that subscribe button and turn on notifications. We've got a lot more to cover. Thanks for watching, and I'll see you in the next video.